If you've been waiting for Perth's market to slow down, it doesn't look like that's going to be happening anytime soon. And the most recent data just confirmed it. Perth is still the standout performer nationwide. Values are up by 1.9% in the last month and 5.4% for the quarter. And if it sustains that growth rate over the next 12 months, we're looking at another 20% year, which is the fastest growth rate of any capital city. As for listings, they've collapsed to roughly 2,800 homes, which is 45% down on last year. And that's at the same time that demand pressure is at its very hottest, with days on market dropping to just 8 days. And that's the lowest level that we've seen in over a decade. So that's no longer a tight market. That's a market that's gasping for stock. So how can Perth still be surging after an 80% run since 2020? Well, the answer isn't hype, it's data. And by the end of this video, you're gonna learn why Perth's supply crunch is unlike any other city, how its demand engine keeps strengthening even with elevated interest rates, why affordability is the hidden weapon that's keeping momentum alive, why parts of Perth still have real growth left, and lastly, how yields are quietly separating Perth from every other capital city. And you're gonna wanna stay right until the very end, because I'm gonna show you exactly where the data says that growth is still sustainable and where it's already been capped out. Guys, my name's Josh, I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you hit the like button and subscribe so you can continue to see data-driven insights just like this. With that said, let's dive straight into the data and start with the factor that's keeping Perth red hot. You see, every property cycle, it begins and ends with supply, and Perth's supply is in a category of its own. At the end of October, fewer than 2,800 listings were on the market. And that's not just a record low, it's the lowest per capita level of housing availability of any city in Australia. You see, even before COVID, Perth carried almost double the amount of stock, and the building industry simply can't fill that gap. Completions are still running at around 15% below the decade average, and starts are even lower than that. You see, costs are high, tradies are scarce, and land development is slowed by infrastructure bottlenecks and planning backlogs. If we look at this article from the AFR, you can see that most states recorded a decrease in home building costs, except for Western Australia and Queensland, which recorded growth of 5.4% and 2% respectively. So if we look at WA at the moment, it's got cost escalations that are exceeding any other capital city. And that makes it extremely challenging to resolve this supply crisis. In other words, this isn't cyclical, it's structural. And that distinction matters because cyclical shortages, they fix themselves. Structural shortages, on the other hand, well, they compound. Whilst Sydney and Melbourne can build their way out of their supply shortages across a 12 to 18 month time frame, Perth can't, not without a multi-year pipeline recovery. And that's exactly why buyers are competing for the same handful of listings and why price momentum hasn't faded even after years of growth. And every extra 1,000 people that migrates into Perth adds roughly 400 extra households worth of demand. And there's no excess stock left to absorb. And the most recent population data coming out from the ABS shows that Western Australia's population has grown by 67,500 people, the fastest rate of any state by far. And that's the single biggest driver of sustained price pressure heading into 2026. But it's only half the story because demand isn't slowing either. And this time, it's not just investors that are driving it. You see, Perth's demand engine looks completely different to what it looked like 5 years ago. Back then, it was heavily investor-led and volatile. Now it's broad-based. You've got families, upgraders, skilled migrants, and locals trading within Perth's corridors. Along with having the quickest population growth of any state, strong resource and infrastructure projects combined with defense supply chains and logistics hubs are all pulling workers out west. And crucially, these are all high income jobs. You've got engineers, project managers, technical specialists, the type of employment that can service a mortgage, even at 6% rates. And Perth has certainly proven that in the last couple of years. And at the same time, vacancy rates have been stuck under 1% for over 3 years in a row now. And that's a brutal environment for renters, but it's also why first home buyer activity is picking up again. You see, when the cost of servicing a mortgage is similar to the rent that you would otherwise be paying, people make the jump. And Perth's relative affordability makes that decision easier than anywhere else. At the same time, sales volumes remain above the 5-year average, even as rates remain high. And this tells you that demand isn't sentiment driven, it's structural. People need housing. So whilst East Coast investors may have already priced out the demand pool from their perspective, Perth and its own domestic population certainly hasn't. And that's why its growth is remaining steady and sustainable. We're no longer seeing a speculative surge. It's a population surge that's meeting immovable supply. And guys, if you're serious about building wealth through property, don't just watch through the sideline. Make sure you join my exclusive DataEdge Property Community in the description box down below. It's where other like-minded investors can share their own insights, and I provide city and suburb breakdowns before they ever hit YouTube. And remember, it's completely free. And whilst you're there, grab my completely free property due diligence checklist as well. It shows you how to spot red flags, zoning risks, and rental demands so you don't end up purchasing the wrong asset in the right market. And with that said, let's talk about Perth's secret weapon, affordability. Now I'll bring up the most recent Cotality Home Value Index, and let's compare the numbers. So the median house price for Perth currently sits at $888,000. And when you compare that against Brisbane at $992K and Sydney at a whopping $1.25 million, you can see the disparity growing. That's roughly a $400,000 gap to Sydney for similar sized homes and often larger blocks. And that affordability gap is what gives Perth its layer of insulation. You see, even with price growth continuing, the cost to income ratio in Perth is still materially lower than other capital cities. And that means that buyers out west can absorb higher interest rates without restricting their borrowing capacity. At the same time, Perth's rental market is the tightest anywhere in the country. Median rents now sit at $700 per week and are still growing at one of the quickest paces anywhere in Australia, up nearly 6% year on year. And gross yields, well, they sit at 4%, with some suburbs still offering yields as high as 5% if you look deep enough into the data. In contrast, Sydney's yields are barely at 3%. And that spread, it attracts investors because they can actually generate positive cash flow, which is something that's largely disappeared from many eastern capital cities. And the key takeaway there is that Perth's affordability is a double engine. It fuels local owner-occupied demand and attracts yield-seeking investors priced out of other markets. But even with that strength, not every suburb still has gas left in the tank. And this is where selectivity becomes everything. And if you want to hear the other side of this story, make sure you watch my video where I compared regional Australia versus the capital cities. It's linked on screen and in the description box down below, and it shows how migration and yield dynamics are playing out beyond the capitals and why Perth could still be setting the benchmark. With that said, let's touch on where the smart investors are focusing now, and that's where data becomes your compass. You see, some of the outer ring suburbs, places like Rockingham, Mandurah, Gosnells, those early boom zones have already surged by over 120% since 2020 and are nearing their ceiling. Affordability in those locations relative to the populations that live there has virtually evaporated, and yields are no doubt compressing as well. On the other hand, the middle tier, areas like Bayswater, Morley, are where owner-occupiers, investors, upgraders, and first-time homebuyers are shifting to next in seek of amenity. You see, these areas have grown strongly, but not excessively. They're still around the city median in terms of values, and close to jobs and infrastructure, and still within reach for dual income buyers. And that combination of lifestyle demand as well as investment demand is what typically drives the second leg of a city's growth cycle. It's exactly what we saw in Brisbane back in 2013 and 2016. The market shifted inwards, revaluing livable middle suburbs before ultimately stabilizing. And Perth is following that exact same pattern right now. The fringe has no doubt overheated, but the middle belt is entering what I call the quality re-rate. And that's where people pay a premium for connectivity and convenience rather than sheer size. And for investors, that's where risk-adjusted returns currently look their best, depending on the person and their own individual circumstances. You see, the middle ring is where fundamentals and sentiment overlap. And when you combine those demand drivers with Perth's income advantage, you start to see why this market is still leading the nation. But here's a quick question for you. Do you think that Perth can continue outperforming heading into 2026, or will another city catch up first? Make sure you drop your thoughts down below. I'll respond to as many comments as I can. Lastly, let's touch on yields and returns, which is one of the key reasons why Perth is still leading nationally. You see, Perth's gross rental yield currently sits at 4%, which compares to Melbourne and Sydney that are both down in the 3%. And that income edge is there before you even factor in capital growth. When you layer in potential annual price growth of 10% or even above based on the most recently quarterly growth rates, total returns are north of 15% or even higher, which is easily the highest combined yield and capital growth rate of any mainland capital city. And that's exactly why Perth continues to attract interstate investors even as rates remain elevated, and there are now question marks around how many further rate cuts we might even be getting. In other words, the equation is still stacking up today even with interest rates where they currently are. And unlike Sydney or Melbourne, where a lot of investors are relying on speculative appreciation, Perth returns are underpinned by real income. You're not just betting on capital gains. You're getting paid whilst you wait. And when yields are strong and supply remains constrained, price corrections are often short-lived because cash flow keeps owners holding throughout the cycle. And that's what makes Perth's foundation so stable. And as we move towards a rate cut environment potentially in 2026, that spread between yields and borrowing costs will only widen, strengthening the city's position even further. So guys, with all of that said, this isn't a bubble. It's a long due overcorrection of value. For over a decade, Perth traded at a discount to the East Coast despite stronger incomes and better yields. Now, the market's just catching up to its fundamentals. You see, population growth, job creation, affordability, and income yields, all four pillars are now aligned. And when that happens, markets don't collapse, they consolidate. Yes, growth will eventually slow, but slow growth that's built on fundamentals will beat fast growth that's built on speculation. And if you're thinking about Perth as a potential market, well, consider looking at the middle belt where scarcity and amenity intersect. You see, the cycle might still be red hot, but the numbers still say that Perth might not be done just yet. Guys, I really appreciate you staying until the very end of the video. And if you got value out of it, again, make sure you leave a like on the video and subscribe so you continue to see breakdowns just like this. And with that said, I'll see you in the next one.